so I'm not gonna say happy new year to everyone, but I hope you all have a good start to the year so far here in 2024. It's gonna be an interesting year. I look around the table, I see a lot of familiar faces from the last couple of years that I've been doing this. Hopefully, the last couple, they didn't take me like they are now, so I don't have to be held accountable in the past. Now I gotta be really held accountable on our predictions. No, I'm only kidding. There's no predictions here. I have always said to you all, the times that I've been honored by Mike and Chris to come out and present to you all, is to just give you the facts, right? Just to give you the math, right? Because if you think about it, where we're standing right now, 2024 is going to be a very, very high anxiety year because of the federal election. But also, it's also going to be a volatile year too, especially in the first half of the year, because historically, when you look at election years and go back to 1928, from 1928 to 2020, every 4 years we have a federal presidential election, yes? If you do that math, every 4 years, we've had 24 of them. 24 federal president elections since 1928. This is now going to be the 25th. I got a pen for somebody. What is the average return on the S&P 500 in a presidential year over the last 24? Anyone want to take a guess? 12% we got. Anyone want to go higher than that, lower than that on the average return? What we got? 15. We just went higher. I feel like Bob Barker right now. Anything else? Lower? Nobody? I'll give this to this gentleman who's ordering right now. It's not even double-digit returns. Not double-digit return. We had a 12 and a 15. I had to give it to the 12. Under. I didn't even hear what you said. I think you won anyway. There you go. So it's 7.4%. 7.4%. The S&P has averaged 7.4% in an election year dating back to 1928. The median, here's why I gave it to the gentleman. The median is 10.4, right? 10.4. So what I want you all to think about is today we're going to go through things that you can control as an investor. As Mike said, looking out in the markets. What you can't control.
I'll make a salad.
Hey, Chatterman, be so kind.
Yeah, I'm in the way.
It's all right. Let's gonna slide up. Just slide up one slide. There you go. You slide it down just a little bit. I have my trusty companion here doing this on the floor because I don't want to put my back to you all.
Yeah.
I want to move around.
Hold some body to hammer things.
That's a fantastic. So we're gonna walk through a couple of things about what you can control, what you can't control. And I think right now you say to yourself, the one thing you cannot control is volatility. You can't control volatility in the market, right? If you think about it, you have to pay admissions to invest in anything. Your business, your children, your retirement, right? But the core aspect of investing is to get some type of outside return for that admission you paid. The admission you paid is volatility, risk to get that return. And if you look at this slide,
Is that high risk or is that just like where we're usually at?
risk in regard to what?
Are we, like, we're in a high risk?
Environment?
Yeah.
You're saying? So high risk environment are we in right now is what my friend over here asked. In an election year, historically, the first half of the year, right now, they're basically 4th of July. A lot of high risk. Why? Because the stock market, not the economy. That's why I want you all to walk out of here today, and I've said this before. The economy and the stock market run on two different rails. Two different rails. They're not one and the same. One and the same. CNBC, Bloomberg trying to talk to you all that they're both the same. They are not. And we'll get through that in a second, right? But volatility is higher in a federal election year, such as this year, more than 2 to 1 usually, than a year that you don't have an election. So be prepared for that in the first half. First half, because the stock market, not the economy, the stock market likes certainty, it hates uncertainty, right? It can deal with disappointment. There's going to be a lot of uncertainty in the first 6 months of this year. Yes, we see that Biden's running on the Democratic ticket. Trump might be taking the Republican ticket. We'll see what happens on the independent side, right? But the first half of the year, the market is going to try to get its footing on handicapping who's going to possibly be the lead horse coming out of this in November 5th. And then looking ahead, which the market does, out 12, 18 months, the impact their policies will have on the economy in corporate America. Right? Does that make sense? Did I answer your question? And this slide, I'd like to show you all, sorry, my friend, I'll take over a little bit. This slide shows you, I think, looking at the annual returns, I show this to you all every year, right? To start off about expectations, is when you think about your kids or yourself, your grandkids, your nieces or nephews, we've all had chicken pox. This is the chicken pox slide. But the chicken pox you see, the red dot, has happened every single calendar year going all the way back to 1980. This is a slide looking at basically the S&P 500, not a diversified portfolio that Michael and Chris put together for your outcomes in retirement. It's looking at the S&P 500, gray bars vertically, going back to 1980, basically the last 44 years. But notice every year, whether the S&P is up, positive, 33 out of 44 years, if you do the math, that's 75% of the time. We like to say at JPMorgan, the stock market, not the economy, is like the seasons. If you think about it, we have short winters and long summers in spring. Think about the stock market. 70% of the time, you have a long summer or spring. You're up 70% of the time. You have a short winter, less than that. But notice every single year, there's a chicken pox, no matter if the S&P is up 75% of the time, or if it's down that short winter. What's the red chicken pox? What did I say at the beginning? Volatility. Volatility in the stock market. And your average peak to trough decline in a calendar year since 1980 is down 14%. I just said it, down 14%. If you look at this past year, in 2023, S&P is up 24 for the year, but during the year it had a chicken pox of down to 10, right? Peak to trough decline in its price. Volatility. It was less than the average, not bad, right? But some years you're going to have like 2009, where you're down double that, down 28% chicken pox. But yet you finished up the year positive of 26. Did you stay in the market? Did you have patience? You can control. Remember I said, we're talking about we control and can't control? Control your patience. And that's why you work with trusted advisors like Mike and Chris. Help guide you as a steward of capital so that you don't shoot yourself in the proverbial investment foot to disrupt your retirement outcome. No matter if you're 25 out of 75, because you have chicken pox happening. Don't let the chicken pox disrupt your retirement glide path. Does that make sense? Now, I would say when you start looking at volatility right now, I'm going to go up to now. Let me just go on. Sorry about that. When you look at volatility, you know, the one thing that's on all your minds, right, is what I said before. We're in an election year. Okay. This slide, there's nothing here to buy because there's nothing here to sell. What this slide is showing you all, and I need you to think about this again, about patience and what you can control and managing expectations through a year that's going to be volatile. You're looking at from 23 back to 2000, it's the last 4 presidents. The squiggly lines are showing you if you voted Republican in red or Democrat in blue, and let's say from 2000 to 2008, you're Republican and you voted for Bush. You believe, looking at that red line, that he did a great job with, not the stock market, the economy. Democrats said he did a horrible job with the economy. Go to Obama, 2008 to 2016. You voted for Obama. You felt he did a pretty damn good job with the economy. Republicans did not. Voted for Trump from 16 to 20. See the pattern? Economy. Now the economy. Let me ask everyone in the room and everyone on television. Do you invest because of the economy? Does the economy help you get to your retirement outcome? He does, right? Also, too, you got to get a number, right, for retirement. I need 8%. I need 10%. Does the economy help you with that? No. Mike and Chris do. Notice, here's the S&P 500. Notice, Obama was in for his 8 years. The S&P was up 16.3%. When Donald Trump was president, it was up the same. Why do I show you that? Because at the end of the day, retirement is about getting the outcomes and performance, right?
That just coincidental, or is that what I mean? These presidents have anything to do with these numbers?
Zero. They have nothing to do with it. That's the point of the whole conversation. Has nothing to do with it. Why you get those numbers is predicated off of monetary policy and interest rates, how corporate America looks at labor and hiring, how they look to incorporate artificial intelligence or not, how do they get their margins, what are they making? That's performance. So the media is going to talk to you about how presidents change the dynamics of the S&P 500. No. Okay. At the end of the day, what this is telling you all is simply don't let your views of politics cloud your judgment on where you want to be in retirement. They have nothing to do with it. It's about stocks, it's about bonds, it's about interest rates. That's the end game. Does that make sense?
Yes.
Right.
So if this Trump gets convicted, we don't have to worry about anything. Nope.
Trump has nothing to do with margins for Netflix, for Deere, for Caterpillar, right? Revenue. Nope. Nothing. Nothing. Any questions so far? So let's look at the economy. As Mike said, Mark Kirby's got all the predictions of how things are going to go. Let's start with GDP, gross domestic product. All we're showing here really quickly on the right-hand side, just for color purposes, you're looking at GDP from 3Q bottom right of 2023 all the way to first quarter of 2021, right when COVID was still at large. What you'll notice is a lot of people will say, you know, GDP, didn't we have a recession, Mark, in 2022? Because historically, you read the Financial Times, when you have a recession, you should see 2 quarters of back negative GDP, and we're not in a recession. Well, if you could see where the breakdown is, the components of GDP, yeah, it was a little strange. I mean, we were perplexed by it because you can see green is government spending. In government spending, when people say, what is that? You look at fiscal policy, obviously, you look at municipal state policy. It's looking at, obviously, expenditures, consumption expenditures and investments, right? Net exports is purple. Private investment is obviously business services, corporate America, the S&P 500, companies spending, right? And business investment. Residential, think housing, okay, in gray. And what's the most important component of gross domestic product? Everyone in this room, the consumer, is blue. You all see that? And notice in first quarter of 2022, as well as second quarter of 2022, it wasn't so much the consumer. Government spending was down, right? Abroad, our inventories were built up too much because of COVID, and exports weren't doing well, again, because of supply chain issues. You had this anomaly happen. We're still waiting to see, are we going to get into a recession? And I'm not here to predict that or not. And everyone's saying we had so much inflation because of COVID and the government spending, which is true. But there's some people in my organization with schizophrenia that believe we may not be going into a recession to see, again, 2 negative quarters of GDP. You know why? Because if you look back at World War I, post-World War I, 2021, 2022, 2023, post-World War II, 46, 47, 48, the same scenarios happened in the economy. You had a lot of spending, wars are expensive. You had a hell of a lot of inflation afterwards, right? But you didn't fall into a deep recession. Could COVID have been World War III, for lack of a better phrase? We're going to find out. A lot of spending, a lot of inflation, right? And now we're starting to see that roll over. So when you look at GDP this year, we think GDP is going to come in somewhere around, for 2024, lower, around 2%, because we're going to see that probably going to see a slowdown as we progress through the year, and the Fed starts to look at maybe maneuvering the yield curve and start accommodating with making inflation less of a concern because of taking rates down. So if you look at inflation right now, again, things that we can't control. If you look at inflation, long-term 50-year averages are around 3.9 on headline, or is 3.9 as well. As I've told you over the last couple of years, when you look at headline inflation relative to core, headlines factoring in food and energy, which is very volatile, very oscillating. If you strip that out and just look at the rest of the indicators of it, you can see that it's sitting now at 3.9, almost in line with headline at 3.9. So we're sitting at, now my apologies, this is December, headlines at 3.3 because energy has come down pretty significantly. And so as food, core CPIs, let's just say 4%. The Federal Reserve is going to want to start cutting interest rates when they feel that the Fed funds rate, which is sitting right now at around 525, 550, has about a 200 base cushion between that core CPI number of 4 and that 525. So we might not see the Fed cut, and we're in the camp, start cutting interest rates until maybe the back half of this year. Does that make sense? The market right now, the stock market, is discounting that they're going to cut interest rates somewhere between 125 to 150 basis points by March. Is the Fed going to get, is this number or going to get down to around 3% by March? I think so. So the market's ahead of itself. Market's ahead of itself. This is something in regard to inflation. When you think about what the Fed is doing with their interest rate environment, is right now the Fed is saying, we believe on this chart. Here's the Fed funds rate right now, say between, let's say 525 and 550. My apologies. The market, the Fed is saying they're going to cut rates 3 times by the end of this year to get it down to roughly around 4.6. The market is calling 5 to 6 rate cuts, and they think a lot of them are going to happen by March. Not going to happen. There's one thing I can say to you all, not going to happen. The Fed does not want to be Arthur Burns, Fed chairman back in 79 and 80. Arthur Burns' biggest ever, why he's looked at as the worst Fed governor in U.S. history, is because inflation came down. He decided to act too quickly to start cutting rates too quickly in 79, 80, and then guess what happened? Energy took off again. He had to do catch up. We went into a recession. Who was brought in? Volcker. Right. And then Reagan was elected as president in 19. This Fed chairman Powell is going down right now as the second worst ever because of his transitory comments, right? He doesn't want to be number 1 in the annals of history. So there's a better likelihood that the Fed is going to sit to make sure that there is no ambers from inflation flaking around and then causing another dust up in the months and quarters ahead. So that means, in our eyes, that when you think about investing, when thinking about fixed income, when thinking about equities, right? Fixed income, I said this to you all last year, early and wrong, was that I said to you all last year, this time last year, don't be surprised on the back half of 2023, that fixed income starts to outperform equities. Dead wrong. S&P was up 25, NASDAQ was up 50, the 60-40 got resuscitated. It was up over 18 after being down over 13 in 2022, right? Bonds only were up around 2 to 3% last year. We thought the Fed was going to be cutting last year at the end of the year. They didn't, right? But what I want and what I stated to you all last year was a quick little acronym, FIFA, F-I-F-A, if you remember that. And I said, I'm not talking about football and soccer. Very good. People listen, Mike and Chris. FIFA stands for fixed income, finally attractive, right? Now it's even more attractive, especially as you're getting closer to the Fed at the precipitous of cutting interest rates, right? They cut rates, bond coupons come down, prices on the bonds go up. This is what we return. That's appreciation. To show you some math on this, I just want you to look at the right-hand side of the page here. This is showing every fixed income asset class. Some of you probably own them individually or through, mutual funds, ETFs, etc. 2-year treasuries, 5-year, all the way to 30-year treasuries. The Barclays aggregate, the actual bond market that we at JPMorgan and all money managers basically index off of where our portfolio is. And then you can see all the components of the corporate bond market, from investment grade corporates to high yields to municipals to asset backs to mortgages. They say, that's great, Mark, but what's the performance over here? The impact of a 1% move, either the Fed raising rates 1% or the Fed cutting rates 1%, right? This shows you every one of these bond securities, how they act, what they deliver to you as an investor, if one of those two scenarios play out. So case in point, if we look at just the bond aggregate, look at the blue. Blue says, if the Fed cuts rates 1%, now they never cut rates 1% at once. they usually cut 25 or 50. But let's just say they do it a 1% cut, right? Performance wise, just your core simple ho hum bond index are going to deliver long-term S&P returns over the next 12 months on average. That's huge, right? People finally attractive. Now, let me just say this to you all. If the Fed raises rates 1% over the next 12 months, I don't think it's going to happen, right? Something exogenous would have to happen for them to do that, right? Such as oil taking off or inflation taking off, right? This is why we're saying they're going to sit for a while to make sure that there's no ambers floating around in the sky. But let's just say they have to raise 100 basis points. Your worst case scenario for bonds, they raise 1%, worst case, you're down 1.5% on your principal. That's not factoring in a coupon of 4%, right? So digest that a second. That's showing you every asset class here. Blue is showing you that what the performance would be a year from now if the Fed cuts rates, which is more likely by 1%. The gray is showing you worst case if they have to raise 1%, what your performance is going to be from a year from now. So you can see why, just looking at the average, we at JPMorgan are pretty excited that fixed income, the last year early, is finally attractive. You get some really outside returns that complement to your equities over the next 12 months. Does that make sense? Yes. Yeah. Now, staying on that point in regard to fixed income, this is a chart that I think is really important to show you all. I didn't show this to you last year, I don't believe, but it's even more profound now, is since really the Fed started raising rates March of 2022. So basically the pause last summer, they raised 11 times, right? 25, 50, they had 4 in a row of 75. For those of you that have cash, for those of you that are in money markets, savings accounts, CDs, pretty good returns over the last 18 months, yes? 4%, 5%. Oh my God. What do we do for that? Because prior to 2022, what were you getting in your money markets? Savings accounts. Nothing. Buckets. Zero interest rates. That's what it does. Hopefully we're never going back to that. I don't think we will. But you get a pretty good hand. You had something more than just owning equities as a saver. You could buy CDs and money markets, right? What I want you to see today is, again, what you could control. The best investors are the most important, right? I'm not, again, making any predictions here. Just look at the math. If we are closer to the Fed cutting rates, as I said, than further away, you have to see how your investments are going to react to it. And how you want to sit down with Mike and Chris to discuss it a little bit further, based on where you are along that glide path. I would say this: if you're a saver and you really can't take oscillating markets and bonds or equities, you stay in your CDs and your money markets, right? But if you're an investor or you're starting out and you want bond exposure, right, and to take advantage of it when it's the most opportune, this chart is basically showing you the last 6 times, 84, 89, 94, 2000, 06, 2018. The last 6 times the Fed had CD rates and money market rates at a peak level, which you can see with the diamonds every year, peak level CD rates. And guess what happened a year later after all those 6 times? They cut rates. And what you're looking at is the colors. Light blue is a 60-40 portfolio, which I think a lot of us are in right here. I could be wrong. 60 equities, 40 fixed income. Notice the 60-40, light blue. A year after every one of those 6 times that the Fed got CD rates to a peak, and then they started cutting, all 6 times, a year later, the 60-40 outperformed CD rates in a pretty significant way. You'll see that. Furthermore, fixed income. In blue, I was just showing you the Barclays ad before. Worst case, if we raise rates 1%, you're down 1.3 over the next year. Best case, they cut rates 1%, you're up 11. You all saw that, right? Look at how just the Barclays ag, ho-hum, or fixed income performed a year after CD rates peaked. We think CD rates peaked in July of 2023. So think about a year out from now, or a year out from then. So looking out now to the second half of 2024, you want to start thinking about how to position for that if you're an investor. Because if you stay in CDs too long or money markets and you're an investor and not a saver, screw up your retirement outcomes long term, right? Big differences in regard to getting 8% relative to maybe 2 or 3%. Same or different story. Does that make sense? The 60/40 ties into that story, as I mentioned to you before. So I just said to you about, hey, GDP this year around 2%, right? Inflation we think is coming down pretty significantly. Bonds are still attractive, if not more, especially with CD rates being peaked out here and the Fed's next step is in cut rates. When you look at the 60/40, which most of I think are in here, we at JPMorgan think this year, with the first half of the year being more volatile, second half being better, and especially if you have the Fed in a very complimentary stance on cutting interest rates, if you look at what is your favorite glide path, do I want to be 100% equities, 80/20, 75/20, 60/40, 50/50, 40/60, 20/80? We think the 60/40, as I mentioned to you earlier, in 2022, it had its worst year ever, down 16%. Since 1974, down 17, 49-year difference, right? You got reversion to the mean where you up basically last year 18% on a 60/40. And that was without the fixed income finally attracted, right? I said S&P is up 25, bonds are up around 2 or 3. This year, as I gave you the stats at the beginning, in an election year, because you got so much volatility the first half of the year, you're probably going to see returns more muted for the S&P between 7 to 8, 7 to 9%, which is good after 25, but then helps get compensated with bonds delivering maybe 5 to 8% based on what I just showed you with fixed income. So if you had to look at a 60/40 portfolio delivering the best risk reward profile moving forward this year, it's to have some credence. And from an equity standpoint, as I just alluded to, this slide is just showing you because I get a lot of this from advisors like Mike and Chris. I get a lot of this from investors like yourself. Hey, Mark, we were just up 25, as you said, in the S&P. We were just up 50 on the NASDAQ. 60/40 was up, you just said 18%, right? Should I be owning value or growth? Bloomberg is saying the Magnificent Seven, as I like to call them, the fat man stocks. Facebook, Apple, Tesla, Microsoft, Amazon, Alphabet, NVIDIA. They drove the market last year. Without them, earnings would have been in a recession. I'm going to say that again. Not the economy. Earnings, the 11 sectors of the S&P, when they have a peak to trough decline. Remember I showed you the chicken pox on the S&P? You get the same thing in sectors, the highest watermark to the lowest watermark. You had already an earnings recession of down 13, 14% in tech, the Magnificent Seven, Batman, and telecommunication services, not in 2023. In the third quarter of 2022, and the fourth quarter of 2022. Take a look at those Batman stocks. When you go home tonight, pull up Yahoo, look at their price in September, October, November, December of 22. They were hitting their all-time lows that they haven't seen in over 4 years. They had an earnings recession. Those sectors already had an earnings recession. Those sectors may be the sectors, if we do have a small recession that's shallow, looking at the back half of the year. I'm not saying those stocks won't capitulate and move down in price, but they may not move down as much as a utility or as a consumer staple stock or a financial stock because they already had their earnings recession. And that's why on this chart, you can basically see on the left-hand side here, it's showing you going back to 1997. I know that's a little crazy. But you can see the median long-term average, recessions are in gray. And what this slide is showing you is real simple. Growth versus value stocks, right? Who was cheap, who was expensive, going back to 97. And what you'll notice is anywhere where the gray line is above the green is saying to you that value stocks, so think of sectors like financials, industrials, materials, consumer staples, utilities, were really expensive and growth was really cheap. You got that? Yeah. When it's underneath the green line, it's telling you all as an investor that the Magnificent Seven, growth stocks, healthcare stocks, consumer discretionary stocks, were really expensive and value was cheap. Notice, it's still pretty cheap, right? However, it's not just about if something's cheap. It's about relative to what are their earnings doing in the environment that the 10-year treasury is sitting in. And like I said to you all, tech and telecommunications already had their recession. So if we have an economic slowdown, they may be the stocks that we still want to stay allocated into in your overall portfolio. Don't just say, hey, those stocks were up so much last year that there's got to be reversion to the mean, that now I got to be buying all these value stocks. Because we say buckets to that. You want to stay equal weight in value and growth, especially during presidential year. And really, too, what's most important, grow the presidential year out. We're looking out 3, 4, 5 years from now. As an investor, you got to be educated on where is the yield curve of the 10-year treasury, right? It has something to do with borrowing costs in corporate America. And what you see on the right-hand side, this side is more important than this side. This side is showing you since 1979, every quarter since 1979 through 2023 on value stocks versus growth stocks aligned with where the 10-year treasury is. Does that make sense? So if you look at the verticals, the green is showing you growth's performance. The gray is showing you those value sector performance, right? And what you notice across the bottom, x-axis, is 0 to 2%. That's when the 10-year treasury ranges between 0 to 2% since 1979. You notice that growth stocks did a hell of a lot better than value, yes. Kind of like zero interest rates, yes. Growth did real well. But look out to here, 3 to 4%, 10-year treasury, 4 to 5%. Does anyone think the 10-year treasury is going to be at 5% or higher for the next 5 years? Anybody? Anyone in here want to raise your hand? Is the 10-year going to be somewhere between 3.5 to 4.25%? Maybe, right? We don't have an idea, right? But what you notice is you see how many times on the bottom here, number of quarters that the 10-year treasury has been in those ranges. And notice 98% of the quarters since 1979, 98. 10-year treasuries range between 4 to 5%. We at JPMorgan think that the 10-year treasury, right, because of all the debt overhang, and we don't want to be refinancing our debt at 5%, it's going to have to cut away at a lot of other things like defense and education and everything. We think you're going to see more of this 3 to 4% over the next 5 years, right? Which means 6% returns for value and growth. Stay more equal weight instead of trying to be a hero and trying to time which one to go into. Does that make sense? Right. Any questions? So I would say two things that I'm just going to close on is the last. I think a lot of people have this, and I've gotten this question a ton. On being an election year, when you talk about more where GDP is going to be, volatility, what we can control, what we can't control, looking at the bond market, looking at the equity market, looking at inflation, looking at portfolio construction with a 60-40. And you told us and showed us about don't let your emotions get the best of you. Leave your polling politics at the polls. It's all about policy, right? When it comes to investing. This, my friends, is what should be talked about all year this year, right? And in 2028 as well. Because what you're all looking at right here is the 2023, this was through December 15th. I'll give you some numbers that are going to change here as of January 23rd. You're looking at the left-hand side here, the United States federal balance sheet. Everyone gets worked up about. The dollar going to crater. We're going to pay our debt. Am I going to get my Social Security? Am I going to get my Medicare? I'll say this to you all. Anyone that was born earlier than 1946 in this room, or 1946 through 1966, right? You're going to get Social Security. You're going to get Medicare. Not going to happen. It's everyone like me who turns 50 in 3 months. You were born from 1968 out. We're going to have to deal with some changes. Maybe changes in the FICO structure for Social Security. Maybe changes in regard to retirement age being pushed out to 70s. You know, right? It's going to happen. You know why it's going to happen? Because this is what you get in a federal election year that needs to be addressed foremost all the time. Is your balance sheet. Look at the balance sheet right now, just to give you some math here. Here's how I show you total government spending. $6.1 trillion. This has now jumped in just a month to around 6.3 trillion because this was only through December 15th. So 6.3 trillion right now is our debt. On the right-hand side, the sources of finance. Revenues coming in. Sure, some of you are or have been business owners. You run your own households. I don't think anybody, I hope that nobody runs their household the way our government runs our household. But look at this on the right-hand side. Revenues, income. This is the second year in a row the United States government has collected almost $2.2 trillion in tax receipts for corporations as well as Americans like us taxpayers. 2 years in a row. That's not a, we don't have a revenue problem. We have a spending problem. That's on both sides, not just one or the other. Because if you start looking at the revenue, corporate America, insurance, other, then you look at the borrowing. Right now, this number shows you, this is as of December 15th, 1.6 trillion that we borrow, right? They put it on the finance side. So, for just shits and giggles, 6.2 trillion, this is around 6 trillion. Hey, we're pretty close, Mark. No. You back this out, the borrowing, we only produce around 4.6 trillion in revenue. We're 6.2 going out. There's a problem. Again, I don't think, hope no one in this house, in this room, does that with their own household wealth or their business. If you look at this borrowing right now, this has now jumped to 1.72 trillion in just a month. 1.7 trillion, right? If you look at what the interest payment on this is, it says over here 659 billion. That was again December 15th. In just a month, the interest payment now is 714 billion. So within the next 3 years, who's ever president, that ain't going away. Ain't going away. They don't have to address it. It's going to supersede defense by over 800 billion, right? Now digest this a second as you're eating. I don't want to get your stomach upset. Warren Buffett. Martin Charlie Munger, unfortunately, just passed away. Warren Buffett said 3 years ago, if any senator or House representative votes to allow the U.S. budget deficit, okay, to be more than 3% of GDP, they should be let go. Well, ladies and gentlemen, take a look at the right-hand side of the page. You think about the things that you can control, right, with your investments and personal. Here's our federal budget deficit going back to 1973. Don't worry about the light blue and the gray. You don't have to worry about that. I can answer the question if you want. Just look at the dark blue line. Notice from 73 all the way to basically 2008, the great financial crisis. We ran what basically Warren wanted to see. 3%? 3%, based on average, 3.2 to be exact. Budget deficit as a percentage of GDP. For a long time. Look at since 2008 till now, looking out the next 10 years. We're going to run a budget deficit. If the left-hand side of the page doesn't change, we're going to run a budget deficit that's going to be somewhere between 5 to 7% of GDP. Now, add on top of that, the interest payment, right? So you're going to have slower and lower growth unless you have some changes on that left-hand side of the page, because when you have debt that high, you're going to get the debt GDP over the next 7-8 years of over 120%. It's just simple math, right? So what I like to say to people in closing on this slide is it's funny, but it's a reminder. This slide is a lot like, Chris, you come home tonight, you drive home, you pull in your driveway and you see two of your neighbors standing outside doing this. You roll down your window and you're like, ooh, what's going on? And like sewage backup in the neighborhood. Get out of the car, go open the front door, and your house is filled with sewage to the ceiling. You got two options, Chris. Option number one, you're going to raise the ceiling higher, or two, are you going to get the shit out? We got one of my friends, you're eating, you got to get the shit out. But think about this. It doesn't have to be taken out until a certain point. And I want you to really think hard on this, what I just talked to you about earnings, about margins, about the market running separate from the economy. The next 4 years, you can complain You can discuss it with friends and family at Thanksgiving, 4th of July, Christmas, Hanukkah. All you want about this. Next 4 years, don't worry about it. Because the stock market is not worried. And that's how you get through retirement. Okay? They're going to kick this can down the road for further. This is not going to look pretty as I come out here if I'm allowed back out the next 4 years, right? This side's only going to get higher, right? This borrowing is going higher. It doesn't have to be addressed until guess what? What I said to you all, looking at those of you born before 46 or from 46 out to 66. It's not going to have to be addressed until 2030. How long is that from now? 6 years. A lot changes in 6 years, right? So don't worry about this when it comes to your investment outcomes for the next 4 or 5 years. We'll be discussing this the next 4 or 5 years to see how things change. Does that make sense? Right? And I say that to you on closing is the biggest impact on what you can control and can't control is simply looking at staying in the market, right? You work with Chris and you work with Mike as your fiduciaries, the stewards of capital that guide you through retirement, no matter where you are along the curve. 25 years old, 35, 45, 55, 65, 75 plus. You all have different outcomes. It's about the number you need. What you should be caring about for retirement is how much do I have when I sat down with Chris and Mike? How much do I need by the time I retire? And when do I need it by so that I have control, choice, and dignity in retirement, right? Now, the only way you're going to get there, besides working with them, is looking at this. Because this is just showing you, it's simple, the damage you could do to yourself and inflict as an investor if you let a federal election get in the way of it. Because your guy or gal didn't get elected. If you let the Middle East cause you to not invest. If you caused the great financial crisis to happen, 2000 occurring, 9/11, which yours truly was there, right? If you let those things get in the way of you investing, you can miss out on some sizable gains for your retirement. And all this is showing you is from basically January of 2003 to basically December of 2022, 20 years roughly, just a simple investor who put 10,000 bucks in on this date, January 1st of 2003, just 10,000 and not diversified, just in the S&P 500 through December 3rd to 2022. If they just stayed in there through all that noise that I just told you, 100%. They have someone guiding them, massage and keep them in the market. We trust Mike and Chris. They communicate with them. So we have a relationship to get through this. Notice everybody else on the bottom who started with 10,000, but they decided, great financial crisis I'm getting out. The world's coming to an end. Buy gold, buy guns. Okay? COVID happened. Holy snap. We're never going outside again, right? If you missed the best 10 days, look at that significant gap in return. There's something S&P 500. Not on the number you need, not on the outcome you're trying to achieve, right? And best case, 7 of the 10 best days occurred within literally 2 weeks of the 10 worst. So no one knows how to time the market, right? Michael said at the beginning, we're not up here, JPMorgan or American Funds or BlackRock or Vanguard. We can't predict the future, right? We can only see the present clearly right now with what the math is giving us, right? So I plead with you, and I'm sure many of you have, don't be like these folks trying to time the market. It's about timing the market. And again, understanding that you're going to have the chicken pox, right? Going to happen every single year. It's all about what you can control and can't control. So in closing, I thank you all again. I hope something stuck today, a sticky message a little bit. And I wish you all a great start to the year and look forward to hopefully being invited back next year.
Thank you.
Well,